Good morning, everybody. Welcome. We'll call the meeting to order. Item 2 on the agenda is approve the minutes for the meeting of October 9th, 2013. Motion been made. Second. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 3 on the agenda is a presentation by Grant and Eisenhofer Security Litigations, and Mark Weinberg from the firm is here, and so, sir, it's your floor.
Thank you. Good morning, everyone. I appreciate you having me here. My name is Mark Weinberg with the law firm of Grant and Eisenhofer. Here today to talk to you about securities litigation monitoring, and I think the board may have some information on this already, but I brought some more with me, and feel free to interrupt me at any point in time and ask me questions that you might have. As Chairman Smith mentioned, my firm is Grant and Eisenhofer. We are based out of Wilmington, Delaware. We also have offices in New York, Washington, D.C., and Chicago. And we are a firm that specializes in shareholder litigation. And what that means is that when the pension fund invests in certain companies, there are occasionally issues that arise. There could be securities fraud. There could be breaches of fiduciary duty by the board of directors of that public company to shareholders. And we get involved in any type of issues of that type. Let me tell you a little bit about the firm, if I could, first, aside from the fact of where we're located. We were started by two individuals, Jay Eisenhofer and Stuart Grant, who came from a law firm that did mostly the defense of this type of work called Skadden Arps, and they opened up the Wilmington office of Skadden Arps. They broke off years later and decided that they were going to represent plaintiffs in these types of cases, and they brought with them a defense type of mentality to a plaintiff's bar. So essentially what that means is they brought a very conservative methodology to the firm. So I'm not sure if everybody is familiar with securities class actions. If you are, let me know. But those are the kinds of cases that are brought that you've heard of: Enron, Tyco, WorldCom. More recently, there were a lot of the cases against the banks with regard to the housing bubble. And so what Jay and Stuart have done is they've brought a very defense-oriented philosophy to the plaintiff's side, meaning that we're very, very careful in the cases that we choose. We're very selective in the cases that we bring. We only represent institutional investors, and so we have the philosophy that if you're going to lend your name to litigation, if you're going to put your name on litigation, then we are going to make sure that the case is a very good case. That being said, the way that these cases come about is through our monitoring process. I've brought with me a packet that everybody has, and if you look on the left side, there's a monitoring report. It's a report that we send to our clients on a quarterly basis. What that report provides to you is information. The information in that report is on every securities case that was filed during that quarter. So if you take a look, it'll tell you about all the cases that were filed. It will let you know if you have any shares in that particular company and if you lost any money as a result of the alleged fraud in that company. That is all information that you can use to take a look and see what's out there. It's a universe of cases. It doesn't necessarily mean that you have to take action. There's nothing that's happened at that point in time. If you look at the back portion of the report, that's something that's very useful that most of our clients find very helpful to them on a regular basis. That's the world of cases that are settled. And that is where the fund needs to go and collect any money that's owed to them on these cases, and to ensure that the custodial bank, that your bank is filing claim forms to get money back. I don't know if you're aware of the fact, but a lot of times claim forms don't make it to the intended party. Custodial banks don't always file forms. There's a lot of money that is left out on the table in these particular cases. So what the report does is provides checks and balances for your custodial bank to make sure that they're filing those particular claim forms, getting you the money back that is due to you from these cases. The other thing that has happened recently is there has been a lot of activity in foreign countries. The Supreme Court came down with a case a couple of years ago where they have disallowed litigation against foreign companies in the United States. For 30 years, class actions were brought in the United States. If there was a fraud that occurred, the case was brought here in the U.S. on a class basis. The Supreme Court changed that law. So to give you an example, we had a case that was against UBS, which is a Swiss bank. Many of you are probably familiar with UBS. They have a lot of operations here in the United States. The allegations in that particular case against UBS were the illegal tax shelters that they were providing for U.S. citizens and their improper valuation of mortgage-backed securities here in the United States. So even though all of the fraud occurred here in the United States, the courts said that you cannot prosecute that matter in the U.S. It needs to go overseas and be prosecuted in a foreign court. So what has now happened and what the trend is and what's going to be happening more often is these cases are going off to foreign soil, and there's no way for the banks, the custodial banks, to keep track of them. There's no way for them to know what's happening. And not only that, but the rules are very different in every country. Another example to bring home the point is the case that's going on right now that we're prosecuting against Royal Bank of Scotland. In the housing crisis, RBS issued what's called a rights offering in 2009, I believe it was, 2008, excuse me. And again, that was associated with the mortgage-backed securities and what was going on. And immediately after they issued this offering is when the bank almost collapsed and the UK had to take over the company. The government took over that bank, similarly to what happened here in the United States. So what has been going on now is there's a case against Royal Bank of Scotland, but it's in England. And the rules in England are completely different than the United States. In England, in a class case, you need to do something affirmative. You need to affirmatively opt into the case prior to its conclusion, in this particular instance by April of next year, in order to make any recovery whatsoever. So it's not like in the U.S. where the case settles, claim form goes out, everybody fills out their form. You have to do something now if you have a loss in that case. Otherwise, you have absolutely no chance of recovering any money. Not only that, but in England, they have what's called loser pay provisions. So I don't know if anybody is familiar with that, but if the litigation does not go well, then the plaintiffs are responsible for defense costs. And I bring that up because in our running of this particular piece of litigation, prior to filing any documents, we spent $7.5 million obtaining insurance to protect our clients against any type of adverse costs. So that means that we spent 3 years, $7.5 million, proving this case to the insurance companies before we brought anything. Again, these are all types of things that nobody is going to know about unless you have a firm like Grant & Eisenhofer engaged to let you know about this. There was a case that was just just settled recently in Japan against Olympus. We have a case going against Vivendi in France. There's a couple of other foreign cases that are going on. And this is becoming the norm now. These types of cases exist, and unless you know about them, unless you have this report that we provide you, you have no way to know what's going on, no way of recovering any of this money in the event that you do have losses. So the report that we provide you, again, is extremely valuable. It's useful for claims here in the U.S., and it will be valuable immediately with these cases that are going on in foreign countries. One of the other areas where we are specialists, because we are based in Delaware, well, it's not because we're based in Delaware, but we are based in Delaware for the fact that we do quite a bit of corporate governance work. And what that means is when a company breaches its fiduciary duty to its shareholders, then there are remedies in the Delaware Chancery Courts usually. For example, there was a case not too long ago against a company called Delphi, where there was a merger going on, and the CEO of the company had a special class of shares that he had issued to himself, and that special class kicked in when the merger was about to take place, and he would have pocketed $52 million. And that's $52 million that did not go to shareholders. So we filed the case, and we were able to obtain a $49 million recovery in that particular instance, where that money was then spread out to the shareholders who held the company and should rightfully be getting paid when the company engages in a merger. Similarly, you probably heard about the case against News Corporation. Everybody's familiar with News Corp and Rupert Murdoch. There was an instance where his daughter had a company that Rupert bought for approximately twice the true value of the company. Now, that's fine if it's just mom and pop giving daughter a leg up, but this is a public company, and he's using shareholder money to buy this company at twice its value. We file a case saying that he breached his fiduciary obligation to the shareholders. The case ended up exploding because it was right before the phone hacking scandal over in England, and so there's just a rampant culture in News Corporation of do whatever it takes, don't worry about the law, do what you want to do, business matters at any cost. And That's corporate governance, the way the company is run, the culture of the company. And we actually were able to obtain the single largest monetary recovery in Delaware Chancery Court history in that particular case. It was a $140 million recovery. Stuart Grant, our senior managing partner, is responsible for 6 of the 10 largest recoveries in Delaware Chancery Court history. So this is an area where we are specialists, where we do quite a bit of work. Jay Eisenhofer and Mike Barry from our firm wrote a treatise called Shareholder Activism about corporate governance and about getting involved in these types of cases. All of that being said, I'm talking a lot about various cases. The report that we provide to you does not obligate you, or our agreement with you never obligates you to get involved in any litigation. If you take a look in the materials that I provided you, I provided a sample monitoring report or agreement. All that does is provide attorney-client privilege between us and the fund. And it says that we will provide you this quarterly report, you will provide us access to your data. There's no way that you will wake up in the morning and read the paper and find out that your fund has engaged in litigation unless that litigation is authorized through a separate retainer agreement. The reports, once we are up and running, they come to you automatically. They come on a quarterly basis. There's no additional work required by the fund or the staff. It's not going to take up any staff time. In addition, there's no cost to it. We provide you the report so that we are able to get your information. And when we have your information, then we're able to talk to you about various cases that may be of interest if they ever do come about. If your custodial bank charges a fee for us to initially download the information into our secure database, we'll cover that fee. So basically, it really makes sense just to engage and have the report. There's no charge, there's no cost, there's no obligation. We have clients that have worked with us for years and have looked at 1 or 2 cases and never engaged. We have clients that we've worked with for years who are very active in these types of cases because they like to get involved. They think they're doing the right thing. It's all up to the board's discretion. It's all up to what you want to do, how you want to do it. But the important part is getting the information to you so that you can make those decisions.
Any board members have any questions? And you would bring us a case, and we have to decide whether we want to proceed it or not.
Correct. For example, we're looking at a case that was just filed recently, a securities class action case. Well, if we saw that you had a loss in that particular case that made it worth pursuing potential lead plaintiff in that case, we would send you a memo. We would have a process set up where it would either be working with counsel or with the chairman and say, this is the case, here's what it's about, here's a memorandum, we'd like you to consider being lead plaintiff in this case. Here's what we think the fraud is that happened, here's what your damages are, here's where we think this is going to go. And we would either come down and make a presentation to the board, we could do it by conference call, you could have a process in place where you say yay or nay through counsel. It's whatever you want to do, it's however you want to do it. And if you say no, then it's no. If you say yes, being a lead plaintiff involves a little bit of work. There's an ebb and flow of the work as the case proceeds. But it enables you to determine what the fees are for the lawyers. It enables you to be involved in the settlement process of the case and determine what the class case is going to settle for. Similarly, if it's a derivative case, those move a little bit quicker than class cases, but we engage in the same process. I just sent a memo off to a client last night talking about a company called Sanchez Energy, where we believe they've violated their fiduciary duties. They basically paid $2,500 an acre for some land where they want to do exploration, and the land right next to it was purchased the month before for $144 an acre. So it's a family-run company. The Sanchez family provides services to Sanchez Incorporated and Sanchez Energy, and they've got it's all intertwined. So it's that kind of thing where the family's paying the family and the money's going from one pocket to the other. And that's all well and good if it's a family-run business, but when it's a public company, that's your money that's going from one pocket to the other, the Sanchez family. Again, we bring the case to you, we tell you about it, we ask you if you're interested in being involved in it in a lead type of process. If not, you follow along. If we're talking about a foreign case where there's something that you need to do affirmatively, like in the RBS and opt-in, we'll tell you about it. We'll explain to you what the case is, what the risks are, if any, and tell you that unless you do it, you get nothing, and then you make the choice from there. we're based on recovery. We do everything on a contingent basis. So, and that's something, again, that you're able to talk with us about prior to the case. Securities class cases are usually done on a sliding scale. So that way, the larger the recovery, the smaller the percentage. We try to ally ourselves with the class so that, we get you more money, we're going to earn our fee if we do better for you. And so we're willing to do that on a sliding basis. You'll never see a bill from our firm. We're like the only law firm that doesn't have a billing department.
Any other questions? All right, sir, thank you, and we'll let you know what the board decides.
Terrific. Thank you. I appreciate the time.
You're welcome. Thank you. Moving on, item 4 is there's 3 reports, report of judgment purchased, a NOVA class action settlement, and a survey proceeding for Renee. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 5 is ratify the approvals, and there are 3 items, 4 or 5, 4 items, I guess, aren't there? Well, there's A and B, and then, but there's, just 2 items. Okay. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 6 is approved the November claims docket, and that was in your packet. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 7 is approve the following applications for service retirement, and there are 2. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 8 is receive report of death and authorize the payment of $5,000 death benefit, and authorize the secretary to make the necessary changes. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 9 is receive the report of death and authorize the secretary to make the necessary changes. Motion been made. Seconded. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 10 is approve the following application for vested rights. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 11 is approve the following termination of vested rights and commence drawing retirement benefits, and there are 2 of them. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 12 is deals with the disability. And Counselor, do we need to go into executive session?
Renee and I were just talking about that. It's really your choice if you want more specific facts, but the medical report we received from our own physician has told us that these individuals are totally disabled under our plan requirements. So I don't know that we have much to argue or discuss.
Okay. What's the pleasure of the board? Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 13 is investment report.
Good morning, everyone.
Morning, sir.
Have the quarter report and the October flash report. I'm going to touch on a few things in the quarter report. So if you would, just turn to page 4 in the big book, and we'll review capital markets. Equity markets continue to do well. Had a very positive quarter, and as you can see in the middle of page 4, over the last year, stocks have done well. Really, small cap stocks have led the way as measured by the Russell 2000, up about 30%. U.S. large cap stocks up close to 20%, and international stocks, despite having a little bit of a rougher time earlier in the year, have started to come back as well. EFI's up almost 25%. The negative bars in the middle of the page there, the bars that you see below the line, are fixed income and commodities on the far right. So the U.S. Treasury Index down 2%, that's all treasuries. The Barclays Ag, which is the U.S. investment grade, which is treasuries, mortgage-backed securities, U.S. corporate investment grade, down about 1.6% for the year. Really, that's where we saw interest rates jump up in the early part of the third quarter, and bond prices came down. Rates have backed back down a bit, but that's certainly, this has been an area that we've talked a lot about, and how do we mitigate against some of that sensitivity in the portfolio. Now, what we're seeing, and when we're talking to clients, we're getting a lot of questions back. Well, why do we have fixed income? Why should we continue to have fixed income? And we've addressed that you need to have fixed income in your portfolio. It provides liquidity, it provides principal protection over time. And when you see these kinds of losses and you say, well, now where are we in terms of allocation? Typically, you're under now, most investors, because equities have run up so much and fixed income has come down, perhaps you're underweight to fixed income and overweight to equities. You were overweight to equities and you're actually overweight to fixed income because we made some changes to your policy where we've increased the real assets, so that, which includes commodities, from 5% in real assets to 10% or 15% overall, and we're not there yet. We haven't implemented that. And the commodities, we've just been hesitant to move forward with that just from a timing standpoint, and it's paid off. But we do have a lot of clients that are getting annual contributions in, or they're looking and saying, should we rebalance? And we're saying, yes, you do need to rebalance into fixed income. And just keeping this in mind, when we talk about risk, there's so much focus on this interest rate risk right now, and while it does exist, equity market risk is 10 times worse. So if you decide to stay overweight and not rebalance back to your targets, the risk of loss in fixed income, as we've seen, this is pretty bad, 2% loss. You could see a little bit more loss if rates bump up 1%, but it's how quickly rates go up. If rates go up slowly, then you'll see managers are reinvesting, or taking some losses and then reinvesting at a higher rate. But by continuing to maintain an overweight to equities, you're taking on more risk than your targets would otherwise intend, what your risk profile intends. So I think you're not really in that situation. You do have a little bit of an overweight to equities, but it's more because we haven't been able to implement the real assets, and that's been a positive. But it's important to keep that in mind as we get to a point where we're going to need to do some rebalancing, and a lot of investors are questioning that. So if you just flip back a few pages all the way to page 10, and these page numbers are cut off on the top pages, but you'll see what Treasury rates have done. This is just looking at the Treasury yield curve based on maturity. So the far left of the page, where it's 0% yield to maturity and 0 years to maturity, that's the Fed funds rate, essentially. That's the rate that the Federal Open Market Committee controls with their policy making. The markets control the rates across the yield curve. Markets, and to some extent, the Fed through their bond purchasing programs. They do have some other levers there. But what you see is that yields have come up. The blue line relative to June come up slightly, and certainly relative to a year ago have come up quite a bit. And that's where you're seeing that negative return in bonds. Long term, we're also getting a lot of questions now just about long-term expectations. And we haven't, while we did some asset allocation work a few years ago, probably been close to 2 years now, and we're still moving toward that implementation, the expectations, if you will, the expectations over the near term, we would say are muted relative to very long term, 30-plus years. A pension fund, when you're looking at doing your actuarial analysis and discounting your liabilities, we're really looking over a long-term time horizon. And a long-term normal for interest rates, T-bill rates, is closer to 4%. And for 10-year Treasury yields is closer to 6%. We're certainly nowhere near that today. Cash rates are at 0 or close to that. So if we just think about where historical risk premiums have been, Equities still carry a premium. You would expect a premium return, whether it's short-term or long-term, but that premium or the absolute return may not be as much over the next 5 to 10 years. It has been the last couple of years, but it's a long-winded way of saying the next 5 to 10 years, our return expectations for equities are more in the 7% range and bonds in the 1 to 3% range. Longer term, we think things will normalize. And pointing out how fixed income works, and as rates go up, your bond managers are reinvesting at higher yields, and you get the benefit of that. Your portfolio, if you turn to tab 2, I think it's always important to look at all these pages, or the top page where the page number's cut off, but this is page 16. Just looking in terms of dollar growth over the last 12 months, your portfolio has grown by $66.2 million. At the end of September, portfolio value stood right at just a notch under $600 million. At the end of October, you're over $600 million at $611 million. Is that, have we passed the peaks of where you were in 2007, 2008? Year to date, the portfolio has gained about $55 million. From a return standpoint, page 17, now this is a pretty consistent picture that we see with your portfolio relative to policy index and other funds. So you're ahead of your policy index on a one-year basis, slightly behind other funds with 55 to 70% in equity. We talk about this a lot. You have a lower risk profile. When equity markets are going up, your portfolio is not going to be up as much. Two things primarily: the long-short equity is a governor, because we're measuring that component relative to traditional equities, and when the last 5 years equities have run up quite a bit, and that long-short piece, 10%, is not going to be up as much. It's there to provide protection, and so that's why that 5-year number, while up 7.8%, is slightly trailing those benchmarks. But what you'll see on page 19, I think, is evident of that in these risk numbers. And this is an 11-year period. That's as long a history as we have on a monthly basis. The return is slightly lower than the policy index at the end of this point in time, but with a much lower standard deviation. Sharpe ratio, risk-adjusted returns are higher. The beta, which is a measure of the sensitivity, is lower, meaning your portfolio is less sensitive to the direction of the markets. So when they're up, not going to be up as much. When they're down, you're not down near as much. And the up capture and down capture tell that same story. So really, if you think about the objective, is funded status. Keeping your funded status as close to 100% as possible. Your funded status, I think, is close, right, 99%. So you don't necessarily need to take on all of the risk of the market. You don't need to get all of that upside. You want to keep that funded status as close to 100 as possible. So having a little bit less risk than the market and other funds is appropriate, which is certainly what you're doing. Just now flipping to the ASAP, if you will, the October report. You can see on here on the top of page 1 and then in the table some of the over and underweights. And as I mentioned, large cap stocks are overweight. They have run up, or equities have run up, certainly. But your fixed income is slightly overweight too, and that's because the real assets, the new target allocation hasn't completely been implemented. I think we've taken our time in doing some things. The global bonds, made some changes to the international portfolio, adding emerging markets, and then making a change to the managers there. I think we need to start to continue to build out the real asset component, and particularly the commodities. While it's been, I don't want to say we've been trying to be tactical and not doing it. We've just prioritized other things first. It has been a benefit as commodities have been down, but we do want to get that implemented. It is intended to be a long-term strategic allocation as an inflation hedge. So I think first quarter of 2014 we should be looking at a couple of managers to consider, and maybe revisiting just the education as to why, because I know it's been some time there. The other, as we look at cash flows, and we work with Bob and Renee, to manage your cash flows on a monthly basis, really paying benefits. Generally, we're taking just a pro rata share from equity and fixed income from the index funds. I think that continues to be appropriate as they're both large cap and core bonds are a little bit overweight. From if you just flip the page and like to look at composites, the focus on the 1 year now, and at the end of October, total fund is up 15.9% relative to the policy index, up 15.7%. On this page, while we have the individual managers, we also have the composites. So those are your asset allocation components. The large cap composite, which is a combination of Intech and SSGA, for the year is up 27.8%, about 60 basis points ahead of the benchmark, the S&P 500. Large cap, you're implementing this really through the S&P, the SSGA strategy is passive. We're trying to get the index return because it's an efficient market at a very low cost. You're paying a very low fee there. The Intech is a benchmark risk controlled, not trying to take a huge bets, but they're taking some based on how they construct the portfolio, and over time it has added a little incremental value. Within small cap had a great run this year. The benchmark's up 35.4%. You're trailing that a little bit, up 35.2%. That's to be expected. When you have that good of markets, oftentimes it's pretty tough for active managers, and the value managers is underperformed a little here. Your growth manager, and in a time when growth did well, did very well also, so Times Square outperformed. Then the long short, that's really the piece. And one of the things we've seen is within the long short space, many managers, including K2, have increased the beta a little bit, which we think is a good thing, not being so conservative. Because really what we're modeling for the asset class for long short is about 50% to 60% of the volatility of stocks, long-only stocks, over the long term, with a similar return over a long time horizon. What we've seen historically, really through 2009 and 10, was these strategies had only about 20 to 30% of the risk. And so when the markets turned around, not capturing near enough of the upside. But they've opened it up a little, and 16% in a hedged equity strategy over the years is very good. But relative to the policy index, because we're not in your total fund policy index, we're measuring that against the S&P, which was up 27% for the year. But other long-short equity strategies, that's that HFRI strategic, up 10.3%. So relative to peers, doing very well there. The international component, while it did well on a absolute basis, up 21.4%, this is an area that struggled over the last year, and you've made some changes there. We've replaced GMO with Lazard. Harding Levener is a fairly new manager. You've had them just about 15 months now, and they've had an okay run, trailing a little bit, but no issues there with the manager. Emerging markets, another new piece, the Von Tobel, which is very high quality, significant allocation to consumer staples. They did well when the market was going down. Now that it's turned around a little bit, they haven't been up as much. But that's offset a little bit with the Wasatch strategy, which is a smaller cap strategy. The other component that is designed to be return enhancing, but in certain periods of time it will drag your return relative to the policy index down, is private equity, because private equity doesn't, in the short term, it doesn't track the public markets. So when we're comparing to the policy index, your private equity composite, and it's very early, it's really in the beginning stages. It's the private equity program, you're just really now in the putting money to work stage in younger companies, younger positions, waiting for them to mature before you start harvesting the benefits of that. You can see on a one-year basis that's up 3.8%. Much like the long-short, because there's no benchmarks for private equity specifically in the short term, we're comparing that in your policy benchmark to the S&P, which is up 27.2%. So that's showing a drag in the short term, but that's certainly to be expected. Finally, I think Andrew mentioned Western last month, and you may just have seen some news. Western's your Core Plus bond manager. They've done a really good job for you. This is a very opportunistic strategy. It invests in a number of different fixed income components. It's not tied to the Barclays aggregate. This is back to this interest rate issue we've talked a lot about. The Barclays aggregate or U.S. investment grade bond market today, if we're using the index as the market, is about 75 to 80% U.S. government securities. You've got treasuries, agencies, and agency-backed mortgages that make up most of that index. Corporates and other non-agency mortgage-backed securities are a very small portion of the Barclays Ag. So if we're concerned about interest rate risk, we need to be doing something different than what that index is doing. We shouldn't be beholden to that index. And Western has been that component. They have the ability to invest in high yield or below investment grade, bank loans, non-U.S. and emerging market debt, and they're doing all of those things for you, subject to some limitations. And that's why you see the pretty substantial differential returns, looking on a 5-year basis, up 9.4% relative to the benchmark, up 6.1%. Western's been may have heard some things about them, and we had, with respect to turnover. Coming out of 2008, Western really got hammered in 2008, as you can imagine, with the kinds of strategies that they had in their portfolio, fixed income portfolio, in a period where only thing that worked was treasuries. They were down about 20%. So they had a massive asset decline. Through that, in 2009 and into 2010, they did some restructuring of people. And if you look at just raw numbers, they've had close to 30 people on their investment team leave since that end of 2008. Their investment team is over 130 people. So on an annual basis, it's not a lot of people on an annual. It's about 3%, 4% a year. But more recently, they've had several people from their structured product group, which structured product would be mortgage backs and asset backs, that have left, that have raised some concern as we look at their portfolio and say, well, you still have roughly 30% of this portfolio is in what we would consider to be structured product. So how is that impacting this going forward? Well, we've had several meetings with the team. Just at your last meeting, the day of your last meeting, Ken Leach, the CIO, was in our office, and we met with him for several hours and just went through the team, the people, process, what's changing, and really focused on this mortgage, the structured product group. And we've come away comfortable with what's going on there. The way the team that they call the structured products team is really focused solely on the non-agency backed mortgages, so the mortgage-backed securities that have credit risk, that aren't backed by the full faith and credit of the U.S. government. That really is only about 5% of the portfolio. The rest of that 35+% in mortgage-backed securities is agency-backed mortgages, which the way they manage this portfolio is really an interest rate play. That's a top-down decision coming from Ken Leach. So the changes to the team, a lot of it has been retirements, people going to other businesses, but they haven't, or other industries, getting out of the investment management business. When you hear that number and one firm, you start thinking, well, is there something going on there? Is there something wrong? And we're comfortable now. Particularly for your portfolio, as we look at different clients, situations may be different, but what you've done and the way your fixed income is allocated, we have the core piece, kind of the index piece, which is there for security, liquidity. We've taken that way down. The core plus in the Western, which can go anywhere, but is going to have a heavy emphasis on credit. That's really been, when you think of Western, that's what you think they're doing, high yield, bank loans, and credit analysis. And then we've added the Brandywine piece for the global exposure. We've brought down the exposure to Western pretty considerably. You took $50+ million from them. when was that? In March, I believe, last March, when we funded Brandywine, 40 to 50. I think Brandywine's number's 40. We might have done some rebalancing, too. It was closer to 50. So just so there is news and issues around them. We're comfortable with it. We don't think it dictates a change. What we would be wanting to do is replace, if we were going to make a change, it would be to replace them with someone that does what they're doing, and there's only 2 or 3 others that are just as good as them, and they're all large firms that have 120, 130-person investment teams that are going to have turnover in their investment teams. We got our arms around how that this is not an issue in their agency and mortgage-backed team, and so we'll continue to monitor it, but we're comfortable with it at this point. And so overall, your fixed income has done well on a one-year basis, up 1.8% relative to the benchmark, which is down 1.1%. So the way you've structured it has been a positive and added positive return. So just finishing up, back to where I started, I think as we look into 2014, one of the things we want to do is continue to complete that implementation of the asset allocation that we started, the changes to the asset allocation that we started on about 18 months ago. I think we revisit a little the education on the why during the first quarter, and then begin to move forward with that.
Any questions of Jay? Is that it, sir?
Unless, I don't need to step over lines, but unless there's any questions about securities litigation monitoring, I'm happy to.
Is that, you see no reason why we shouldn't have some firms?
No, I mean, we see most of our public pension clients utilize those. The one thing I would point out, what you're engaging them to do simply is monitor your separate account managers, and you really only have 3. It's Intech and then the 2 small cap managers that they're going to monitor the securities that you own to determine if there's any securities that you own that there may be fraud associated with. And the one thing that we would want to do if you did engage this, a firm such as Grant & Eisenhofer or another, is incorporate some language into your investment policy or your internal policies as to how you address the decisions that may come to you. So if they come to you and say, we want you to be lead plaintiff, you have X. And Grant & Eisenhofer is probably one of the most conservative firms out there. They're not going to be bombarding you with every security. We do see others that come in and say, you've got a loss in $30,000 loss in this. Can we come in and talk to you about it? Well, I think you need to have procedures in place that don't address those things. So.
All right. Anything else? Nothing? All right. Item 14 is any comments from staff or board members or citizens? Nothing? 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 If not, happy Thanksgiving to everybody, and it's coming up, and we will see you, and we are adjourned at 10:44.